Hello, in this video, we'll be going through corporate organization. Let's talk about corporations here and what they offer in terms of advantages and disadvantages. So everything we've been talking in accounting is all about corporate accounting. And so what is a corporation, right? A corporation is a separate legal entity, right? It's separate and distinct from its owners, and the corporation is responsible for its own debts. The owners of the corporation are not personally liable for the corporation debts. And also the shareholders' liability is only limited to the amount that they paid to purchase their shares, because so that's the maximum that they can actually lose. Another advantage of a corporate organization is that it's really easy to raise capital because all you have to do is sell stock in that corporation, right? That's selling ownership. And then the corporation gets money in. So ownership rights are really easily transferable, whether you want to buy stock or sell stock, it's really easily transferable, and it's a good way to raise money. Some disadvantages of having a corporation are that the federal government and actually state agencies as well have extensive reporting requirements. There's a lot of paperwork that's required to even start a corporation and then to maintain it, right? And there's also a bunch of tax filing requirements, state requirements. There's just a lot of paperwork involved. The biggest disadvantage of a corporation, a regular corporation, and when I say corporation, it's called a C corporation because there's different kinds of corporations. Here we're talking about C corporations, are subject to double taxation. And so what happens is, here's your corporation, right? Let's call it Corp. And the Corp earns money, right? Let's say they earn $100. $100 million, and they pay 21% federal tax. So they're going to pay $21 to the federal government. We'll call this to the IRS. And then they have $79 left, right? I'm simplifying this example just for purposes of demonstrating the double taxation point. So they have $79 left, and from that $79, that $79 is going to be distributed as dividends to the individual shareholders. And then those shareholders have to pay tax on whatever money that they get. So this $100, right, this $79 that's remaining is a portion of this $100. So it's already gone taxed once on the corporate level, and then it's going to get taxed again when it's distributed to the shareholders through a dividend. So that's called double taxation. Well, what I just discussed is C corporations. There are different types of corporations. But first, before we get there, a C corporation, it can be a publicly held corporation or privately held corporation. A publicly held corp is one that is publicly traded on the stock market. So you and I can go out and buy shares or ownership in a corporation such as Apple. And there's also privately held corporations. There's some really, really big privately held corporations. And they're just owned by a few people, or they could have 1,000 shareholders. I know a very big privately owned corporation right here where close to where I live, and there's probably 1,000 shareholders, and they have billions of dollars in assets, but they're privately held. So you have to be basically working there and asked to become a shareholder in order to become a shareholder of that corporation. Oftentimes, companies start off as being privately held and then they go public, right? It's called initial public offering, an IPO. An example of that is Rivian. There's other corporations that don't sell stock, right? These are not-for-profit organizations such as churches, hospitals, schools, charities, right? So they don't actually sell any corporation, and they don't they're not subject to that double taxation issue that C Corp is subject to. So instead of a C Corp, you can also organize as an S Corp, an S corporation. And the S corporation eliminates that double taxation issue. But it has characteristics of both the regular corporation and partnerships. And we say partnerships, it's because the income directly from the S corp flows directly into the shareholders, right? And it doesn't get taxed, no tax on the corporate level. And it's also gives the shareholders limited liability protection, but it's also limited to the number of owners it has. So you ask, why doesn't Apple become an S corp, and then therefore they don't have to pay tax on a corporate level? Because the S corp has a limitation on the number of owners. I can't remember if it's 100 or 500, but it's not that big. There's also limited liabilities company also, which eliminate for the majority the double taxation issue. And also the owners of the limited liability companies are not liable for the debts of the business, except to the extent of their investment in the business. And all the members of the limited liability companies, which are often referred to as LLC, can be involved with the management of the business. So think about a C Corp, or like Apple, right, which is a C Corp. Are all the shareholders involved in managing the business? Absolutely not. You can go buy Apple stock, but you will not be making any sort of business decisions for Apple. So that's an advantage with the LLC. And then the income and expenses, like I said, are passed through and they're not subject to corporate tax. And there's no limitations on the number of owners. The last kind of hybrid organization we're going to go through is called limited liability partnerships. And in those entities, the shareholders are called partners, and they're liable for their own action, but not liable for the action of others. So if one partner does something pretty shady, then the other partners are not liable for that action. Let's talk about, so when a company comes about, right, or gets formed, they have to have what's called articles of incorporation. It's also known as the corporate charter. And they have to incorporate in a state. And many corporations actually incorporate in the state of Delaware just because they have less requirements than some of the other states. So it's really corporate friendly in terms of incorporating in that state. But in your charter, in the corporate charter, you have to describe what the business is about, right? The firm's business activity, and the shares to be authorized, the number of shares that are authorized, those are equal to the number of shares that the firm, that the corporation can eventually sell, and a par value, which we'll get into a bit later, if any. And a lot of companies, when they state the number of shares to be authorized, they state a very large number because this is supposed to be the number of shares that they're allowed to sell for eternity. But the reality is they can eventually increase the number of shares authorized, but it takes a vote by the shareholders. So it's a big process that really no one wants to have to go through. And then the final point of the articles of incorporation is the composition of the initial board of directors. And what the board of directors do is that they establish the corporate policies, and they're the ones who appoint the corporate officers, and the corporate officers are the one that will be running the company. So when a corporation gets established, right, they authorize common shares, and then usually they issue, which means they sell shares to those initial officers and board of directors. And so those shares are ownership rights, right? Those common shares are ownership rights held by common shareholders. And what a common shareholder does, so this is, people think of when you see 10Ks and you see common stock or common shares, this is what we're referring to. And anyone who owns a common share or common stock has a right to vote on any matter that comes before the shareholder. So if you go buy a stock of Apple, you now own common stock and have the right to vote. And the shareholders are the one that elect the corporate directors. The shareholders also, the common shareholders also have a right to share in the profits when dividends are declared. So that's how they allocate the profits to the shareholders through a dividend. And then if a company is liquidated, a common stockholder or common shareholder has the right to share in the distribution of assets, although they do not get necessarily priority of those distributions. But if after everyone who does get priority, if there's any assets left, then they will get it. They have the right to that. There's also a concept called preemptive right, and that is when you have common shares, you also have a right to maintain your percentage share of ownerships when new shares are issued. So every time a corporation, right, so let's just make a simple example. If you own 1 share out of 10 shares, right, then you owe 10%. And now if they sell 5 new shares, right? The company sells 5 more shares. Now you own 1 out of 15, and your percentage, your ownership has decreased as a result. Well, the preemptive right says, oh, we will let you buy, a half a share so that your percentage is now 1.5 over 15. It'll remain the 10%. So you can buy those additional shares. I mean, most people do not elect to take advantage of this right, but it is there if needed. There can be more than one class of shares. Big corporations usually do have more than one class of share that's authorized in their articles of incorporation, but the specific rights of each class of those shares has to be stated. And just like we talked in a previous video how stockholders' equity, there's different terminologies for the same thing. Same thing with common stock. You can have a Class A, Class B, Class C. Some people might call it common stock A, common stock B. They might have a preferred stock in Class A and Class B common stock. They might have preferred stock, common stock, and capital stock. Just know that there are different terminologies for share types. So really, there's common stock, preferred stock, sometimes there's restricted stock, anyways, but they could be called different things. Let's talk about preferred shares. So we have what's called common shares or common stock, right? And that's when everyone who owns common stock has a right to vote in the company. But there's also what's called preferred stock, okay? And preferred stock is shares with certain preferences or features that distinguish them from the common shares, okay? So they kind of have different preferences on them, hence the name preferred stock. And there's all kinds of different features that can be tacked onto a preferred stock, and they're really, each different feature will result in the different kinds of preferred stock being sold. But for sure, one of the things that has all preferred stock includes is they include one or both of the following. The first one is that the preferred shareholders get priority over receiving a dividend over the common shareholders. If the board of directors actually declares a dividend, right? So dividend is when they pay a certain amount of money for each share you own. So Apple will often declare dividends, and their dividend might be you get 2 cents for every share you own, or you get 75 cents for every share you own. But the preferred shareholders, they get priority over the common shareholders. Another right that could be the preferred shareholders might have is, again, if a company is actually dissolved or liquidated, the preferred shareholders usually have a priority or preference over the distribution of assets from the common shareholders. So if you go into, when a company liquidates, there's a certain pecking order that all those assets will get distributed to. I think the first one is the creditors, and then it'll be preferred shareholders, and then it'll be the common shareholders. So some of the, oops, let me just go right here. Some of the rights that preferred shareholder might have are the right of conversion or redemption privilege. So a preferred shareholders might have the right of conversion, means that those shares, the preferred shares, can be exchanged for common shares at a specified ratio. So it could be that for every 1 share of preferred stock, you can convert that to 3 shares of common stock, right? That might be the conversion ratio, or it could be whatever the corporation deems appropriate. Or their preferred shareholders sometimes have what's called a redemption privilege, which means that the preferred shareholder is allowed to return the preferred stock for a specific dollar amount, right? It has nothing to do with the market value because it is a predetermined price. Now, some of the different types of rights that preferred stock might have is they might have a cumulative or non-cumulative. So the way preferred shares are typically issued is that they will have either, they'll say that the dividend is a percent of the number of shares times their par value, if the stock has par value. Or it might not be a fixed dollar amount. So they might say each share gets $5 preferred, gets a $5 dividend. So the dividends that are paid on preferred shares have nothing to do with the earnings of a company, whereas the dividends on common stock or common shares absolutely do have everything to do with how the earnings of the company. So the cumulative preferred shares, let's just say, just to make it easy, that I have 100 shares and my preferred share, 100 preferred shares, and my shares say I get $5 dividend per share. So I should get $500 per year in dividends. So the cumulative says, oh, well, in year 1, if the company doesn't declare any dividends, doesn't matter whether they do or don't, I should get $500. Now, let's just say they didn't even pay me the $500. Now, year 2, now they've declared dividends for, let's just say the company said, oh, we declare we're going to pay out a total of $10,000 in dividend. Well, guess what? I'm going to be first in line because I'm a preferred shareholder that has a cumulative preferred shares. And they're going to pay me my dividend from year 1 because they didn't pay it for me last year, and the $500 that they owe me from this year. It is cumulative, okay? And that amount that's first $500 from year 1, it's called a dividend in arrears. But versus a non-cumulative means that if in year 1 the company declares $0 of dividends, then I get nothing. Now in year 2, let's just say in year 2, the company declares $700 of dividends. Well, guess what? They're going to pay me first my $500, and then the remaining $200 will go to the common shareholders. That's non-cumulative. I don't get paid for the year 1 dividend because I have a non-cumulative preferred share. So preferred shares are kind of a hybrid between equity and debt. It's equity because I do have ownership, some sort of ownership in the company, and I do get dividends each year that the company actually pays them. But they're debt because sometimes, like if it's a cumulative preferred stock, the company is obligated to pay me those cumulative shares, even if they haven't paid them, in 10 years, then they owe me 10 years worth of shares. Or sometimes you have preferred shares that have a different type of right, and they are mandatorily redeemable. And so that means that the company must pay me cash at a fixed or determinable rate in the future for those shares. So that's more like a liability. So if you have a mandatorily redeemable preferred shares, they're actually treated as a liability on the balance sheet and not shareholders' equity. But the cumulative preferred shares, cumulative preferred shares are reported on the stockholders' equity section, even though it's kind of like a debt, because once they declare those dividends, they owe me the dividends from, dividends in years from prior years that they haven't paid. So let's just talk about the basics of capital stock. And you'll see this on any 10K if you look at the statement of shareholders' equity or in the balance sheet in the shareholders' equity section. You'll see common stock, and they'll say authorized this number, issued this number, and outstanding this number. Authorized numbers are the number of shares that the corporation's charters allows it to sell. That's when day one, when they create that corporation, they say this is the number of shares. So usually that's going to be in the millions and millions of shares. Issued stock is a number of shares that has actually been sold to shareholders from the beginning of time. And then you have outstanding stock, so that are the number of issues that are held by stockholders. So these are the key differences. The issued stock is the number of shares that were actually sold, and outstanding is the number that actually held, right? So they could sell to all these different shareholders, right? These different number of shares, but then also the company can actually buy back some of their shares, right? But those shares, so let's just say they sold $1 million shares, but they purchased back 200,000 shares. Well, in that situation, then they've issued 1 million shares, but the outstanding is going to be only 800,000, because that's the number of shares that are actually held by stockholders, because the corporation itself purchased its own stock back. And that's called treasury stock, covered in a different video. And then there's also the different classes of stuff that we've talked about, common or preferred. Last slide is the concept of par value. And when a company incorporates, right, and they have to say the number of shares authorized on their articles of incorporation, they may or may not give this par value to each share. And it's the par value is originally indicating the real value of shares, but it's really, think of it as an arbitrary amount. It has nothing to do with the actual value of the stock. And if you go into any 10K, if you go to Meta or Apple and you look at their balance sheet, shareholders equity section, it'll tell you the par value, and the par value might be this, right, per share. So let's just say it's Meta. You know that Meta their value of their stock is a lot more than this, less than 1 penny. So it's really an arbitrary concept, but it only matters when you record the sale and purchase of stock, and we'll go through that in a different video.